Hello and welcome to today's Ward's webinar, New Realities of Today's Used Car Business and Methods to Maximize Net Profits. I'm your moderator, Steve Finlay. We're in for a treat today because our very special presenter is Dale Pollak, founder of V Auto. He pioneered using data to make important dealership decisions, and he's an industry icon. But before we begin, let me explain how you can participate in today's presentation. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. We welcome questions and we will answer as many as we can following the presentation, but feel free to submit yours at any time. Use the Q&A window on the left-hand side of your screen. Today's session is being recorded and will be available for on-demand viewing. We'll email you when that's available. If you have any technical difficulties, submit them in the Q&A box. Okay, on with the show. Dale Pollak really needs no introduction, but I'll give it a shot anyway. He is a former dealer and for years now has been one of the industry's greatest thought leaders. He has written several books, and he was an early pioneer, as I said, of developing software to manage dealer inventory. He has attended 50 NADA conventions, which has to be a record. Dale went to his first one as a kid with his dealer dad. His ideas resonate across generations. And let me tell you a quick story to illustrate that. A couple of years ago, I had lunch with a Detroit area dealer, and he brought along his son who worked at the dealership and was relatively new to the business. The son asked me if I could introduce him to Dale Pollak because he wanted to pick Dale's brain and certainly meet him. So I made the email introductions, which really wasn't necessary for me to act as a middleman because Dale is a pretty open and approachable guy. But the point of the story is that, yes, lots of veteran dealers admire Dale Pollak and listen to what he has to say, but so do lots of young dealers. His appeal is multi-generational. And with that, it is my honor and privilege to introduce Dale Pollak. Dale?
Steve, thank you very much for that very flattering introduction. I appreciate it. And hello, everybody.
Of course.
So as Steve said, what I'd like to do is I'd like to share a certain disturbing reality with you regarding the current state of the used car business, and then, more importantly, introduce what I consider to be an essential strategy for improving outcomes in the used vehicle department. So to begin with the current reality, for the past several years, NADA has been reporting to us based on their collection of dealer financial statements that used vehicle departments across America have essentially been at, roughly speaking, a break-even point, meaning that roughly half the dealers in America are running a negative net profit in their used vehicle department, and the other half that are fortunate enough to show positive net outcomes. In almost all cases, with very few exceptions, if you trended those net positive outcomes over the past several years, 2017, 18, 19, and I suspect 20 will be no different, if you trended those positive net outcomes, in almost all cases, they are less profit outcomes every year. So I want you to stop and think about the reality of the situation. In the used car business today, roughly half the dealers in America are running a negative net in their used vehicle department, and the other half that are positive are heading down to negative territory. Now, this happens to be the case in an environment where our industry has delivered record volumes of used vehicle sales over these years of 2017, 18, 19, and 20. I mean, in each one of these years, our industry will deliver close to 40 million used vehicles. Now, stop and think about that reality. If this is the state of the industry, half negative, the other half more or less all headed to negative territory, in spite of record volume, what in the world is going to happen, not if, but when we're no longer delivering record volumes of used vehicles? And it won't take much in the environment to cause that to happen. A few ticks of interest rates or other factors could do that. So what is really most disturbing about these disturbing trends is that I believe that it's largely unrecognized by most dealers. So I'm going to make a case for change. And if anyone's going to ask you to do anything different than how you've been doing it in the past, and particularly when change is hard, and this will be a hard change, you need to have a good reason to do something different. And I would suggest and urge you to begin to look for that reason in your bottom line of your used vehicle department. If it's negative, or if it's headed to negative territory in spite of record volume years of sales, you have to ask yourself, are you okay? Are you okay with that trend or that state? And if you're not, I would respectfully submit that we all need to consider doing something different. And doing something different is what I'm going to introduce to you today. And it is essentially a different approach to used vehicle management. It's what I call an investment-minded approach to used vehicle management. And before I get into what that actually means, I'd like to take a step back and examine the basic strategy, the only strategy that our industry has known for the past 100 years to achieve profitable outcomes in the used vehicle department. That strategy was pretty straightforward. It was sell as many cars as you can at the highest possible average gross in order to generate the most amount of total gross from which we deduct our expenses and have something left over that we call profit. Now, what I have come to understand over these past several years that has caused this unfortunate trend of profitability in the industry is that basic formula is broken. It's actually broken. And if it's not broken at your dealership, it's in the process of breaking down. But for most dealerships, that basic strategy for making that profit is broke. So why is it broke? Well, you see, what's happened as a result of the internet and the transparency and the efficiency in the used vehicle market is that essentially it happened around 2016, roughly mid-year 2016. It was a point of inflection, at which point I think it's fair to say that most every dealer in the industry finally came to realize that this used car business is an internet business, and it's an extremely transparent internet business. It's one that's largely driven by price. So I think by the year 2016, it's fair to say that most every dealership went to work every day with some sort of a pricing tool, with an attitude and a mentality that they need to check their prices, check them ever more often, adjust them more often, and make larger adjustments. And essentially what happened, and it began to happen, as I said, roughly mid-2016, and it continues to happen today, is that at some point that average gross goes so low that you just can't make with extra volume. Not only does the average gross go so low without being able to compensate for extra volume, but every year that goes by, your dealership departmental operating expenses go up. So average gross profit eventually hits some point in your market where it's just so miserably low, and there's not enough volume to pick it up, and operational expenses go up. And this is a large contributing factor, not the only, but a large contributing factor to why our industry is in the poor state that it is from a net profit perspective, in spite of record volume. So understanding that basic formula of just trying to sell as many cars as we can, as fast as we can for the most amount of gross, isn't achieving the net profit outcomes that we deserve, we're going to have to do something different. And what it is that we're going to do different, I believe, is to take an investment-minded approach, a different strategy to managing inventory. And when I say take an investment-minded approach, it's entirely possible that you're thinking, well, I manage vehicles as investments. I recognize them as investments, and I manage them as such. And very respectfully, I would have to disagree. I happen to believe that dealers do not take an investment-minded approach to used vehicle management. And let me begin to highlight that conclusion on my part with this point. You know, if I said to any dealer that you sold a used vehicle and you made a $2,500 front-end gross, without exception, every dealer would say that's a pretty good outcome. And you want to know something? A $2,500 front-end gross on a used vehicle sale might be a pretty good outcome, but it might not. It might not. But presently, dealers have no ability whatsoever to recognize that a $2,500 front-end gross might not be a good outcome. Allow me to elaborate on that point. I would ask you to consider this question. If you sold a $50,000 unit in 60 days and made a $2,500 front-end gross, is that the same outcome for your used vehicle business as if you sold a $15,000 unit in 20 days and made a $2,500 front-end gross? Are those the same two outcomes? And the answer is obviously not. They're quite different. One is a much higher return than the other. However, if you saw two deals on your sales log today, both of which generated a $2,500 front-end gross, it would not even occur to you, wouldn't even cross your mind to ask the question, are these the same two outcomes for my used vehicle department? It wouldn't even occur to you to ask, wait a minute, how much did we have to invest to make that $2,500 front-end gross? How long did it take us to make that $2,500 gross? If you actually were thinking about operating as an investor in vehicle assets rather than a merchandiser of vehicle assets, you would certainly ask those questions, but you don't. And therein lies just the beginning, not the end, but just the beginning of proof that I could show every single dealer that they in fact do not manage used vehicles as investments. You see, the reality is today that there are many dealers that sell large volumes of used vehicles and lose money. There are many dealers that generate a tremendous amount of total gross profit and lose money. But I'll tell you something, any profitable operation has a positive return on their assets, on their investments. And the more positive that return is, the more profitable they are. So the case that I'm going to make to you today to begin to reverse the negative trend of profitability that's affecting you and everyone else in the industry is a hard case for change. It's a case to begin to think and behave not as if we're managing just vehicle merchandise, but as if we're managing vehicle investments. So how would that actually be done? Well, in mid-2016, when I began to recognize the profitability problem that was setting in at the time in the used vehicle industry, we went to work with our data scientists, and by that time we'd been doing business for roughly 15 years or so with thousands of dealers, and we had millions and millions of transactions in our database. And what we did is we looked into those transactions over the past 15 years, and we asked ourselves the question of what causes a vehicle, a used vehicle, to have a positive ROI, return on investment. And more specifically, what we did is we took approximately 2 million transactions and we broke them down into three categories. The ones that produce the highest ROI return, the ones in the middle tier, and then the ones that produce the poorest ROI. And what we were able to readily identify is that there are many factors about a used vehicle in a dealer's inventory that is highly reflective of its ultimate ROI outcome upon sale. However, there are three conditions of a vehicle that have proven to be the most influential regarding its ultimate ROI disposition. Three factors that stand out among all the other by far. And I'm going to share what those three factors are with you. However, not a single one of these three is going to surprise anybody. Each one is going to make complete sense to you. So the first condition of a used vehicle in a dealer's inventory that is reflective of its ultimate ROI outcome is simply how right you own it, measured by its cost to market. And that makes sense to you. The more right you're in a vehicle, the more likely it is to produce a higher ROI. So that first of the three conditions, its cost to market, how right you own it, makes sense to everybody. The second condition that is highly reflective of the vehicle's ultimate ROI disposition is simply the relationship of its supply and its demand measured by market day supply. And that too makes sense because when you have a vehicle that's in high demand and short supply in your market, you've got a much better ability to command your price rather than to be subject to a lot of discounting and negotiation. So that one also makes sense. And then the third factor, highly reflective of vehicles' ROI disposition, is simply its level of retail volume. So is it a high volume or low volume selling retail vehicle in the market? So recognizing that these were the three conditions that most influence a used vehicle's ROI outcome in a dealer's inventory, the next thing we did is we mashed them together into an investment score. And I want to be very clear that they're not equally weighted, one-third, one-third, one-third on cost to market, market day supply, retail volume. The weighting of those three conditions varies according to a number of factors unique to a specific vehicle. But suffice it to say, with proper weighting on any given vehicle, we mashed them together into an investment score, and I want to explain how that investment score works. It's on a scale of 1 to 12. So a vehicle in your inventory today that scores a 12 would be a vehicle that holds the highest possible investment likelihood in terms of a high ROI. That would be a vehicle that you own really right, evidenced by a low cost to market, a vehicle that has low market day supply, meaning high demand, short supply, and a high volume selling vehicle in the market. Contrasting that, you would have a vehicle in your inventory perhaps today that scores a 1. That would be a vehicle that you own for too much money, high cost to market. It's got high market day supply and low volume of retail sales. That would be a vehicle that would likely produce very little, if any, ROI, and very likely a negative ROI. So once we put an investment score on every dealer's inventory, on every vehicle in inventory every day, what we do next is we break them up into 4 categories. Vehicles in your inventory today that score 10 to 12, the highest possible ROI outcome possibilities, we call those platinum vehicles. Followed by what we call gold vehicles. Those are ones that score between 7 and 9. Then followed by silver and followed by bronze. Okay. So one day, in the process of doing this work, I said to our data scientists, I said, take all 12,000 plus dealers that we currently do business with. I said, roll them up as if they're just one big enterprise operation. And show me what their inventory looks like through this new investment lens. And this is what they showed me. Now, there may be a lot of things on the screen that would cause you to question and want to talk about. But there's one thing on this screen that jumps off the page as being patently irrational. Patently irrational. And the one thing that I'm referring to, if you haven't already identified it, is that when we rolled up all 12,000 dealers as if they're just one big enterprise, what we see here is that the bronze vehicles, the ones that hold the least possible likelihood for a high ROI, in fact, they hold a high likelihood for a poor or negative ROI, are the ones that are priced most proudly, as if we want to keep them around long as possible, as if they actually get better the longer they sit in our inventory. And conversely, the platinum vehicles, the ones that hold the highest possible ROI outcomes, are the ones that we're pricing as if they are distressed, as if they're distressed merchandise and need just to be blown out. And this makes sense to nobody from an investment perspective. However, the next question that I asked of our data scientists would be an answer when they gave it to me that would have changed the course of my thinking and my career, and I believe ultimately will likely change the course of our industry moving forward. I asked this question. I said, if this irrational profile, what I call an inverted pricing profile, is what I see when we roll up all dealers together, I said, tell me how many dealers of our 12,000 dealers that this represents, how many dealers don't have this inverted, irrational pricing profile? And the answer that they gave me was stunning. They said, Dale, the answer is 0. Not a single one. Not a single one. I couldn't believe it. It wouldn't be possible in my mind that not a single dealer doesn't have an irrational pricing profile. How can that be? How could you ever say that every dealer does anything alike, let alone something that is patently irrational? How could that be? Well, we ultimately discovered that it's true, and it's driven by a couple of factors. And let me explain what the first factor is. I want you to imagine this. Instead of selling used vehicles for a profit, imagine that you had a banana stand. You sold fruit, bananas. And your objective is to run that banana business like a good, prudent investor would. And today, you get a shipment of inventory in a cardboard box. And when you open that box, what you saw was that not all of the bananas in that box were green. There were some green bananas in that box, but there were also some yellow ones, there were some brown ones, and there were some rotten ones. Now, if you were in that banana business as an investment-minded operator with an eye towards maximizing the return on investment on each one of those inventory pieces, wouldn't the first thing you would do to be grab out those rotten bananas? And by the way, people do buy rotten bananas. They make banana bread out of them. But wouldn't the first thing you do is grab those rotten bananas out really quickly, put them on the shelf right now, and price them really cheap to sell fast? And then you'd go in and get those brown bananas out. You put those on the shelf next, price those a bit higher. And then you would go get those yellow bananas out of that box, put those on the shelf, and price them even a bit higher. And then finally, you'd take the green ones out, put those on the shelf, and price those the very highest. Isn't that what a rational, prudent investor would do? And the answer is yes. Obviously, that would produce the highest possible ROI outcome for that set of inventory. But that's exactly opposite of what we do as an industry today with our vehicles. So why is this? Well, the answer is that every single dealer, without exception, makes pricing decisions on a flawed premise. And that flawed premise is that we improperly assume that the amount of calendar days that we have held a vehicle equates to its profit potential. I'm going to say that again. The flawed premise upon which everyone in the industry makes pricing decisions is that the amount of days that we hold the vehicle equates to the amount of profit opportunity the vehicle holds. In the mind of every dealer, every vehicle on day one represents its highest possible profit opportunity, and as such, we price them as if they're green bananas. But can I tell you what we discovered in the data? You ready for this? More than half of the vehicles in any dealer's inventory on day one are not green or even yellow bananas. More than 50% of the vehicles that reach a dealer's inventory on day one are brown or rotten bananas. But what does the calendar say to us? The calendar says they're all green bananas on day one, and in fact, they are not. And therein lies one universal reason why every dealer is making a pricing decision on every vehicle on a flawed premise at least 50% of the time. And when you make decisions on a flawed premise, what you end up with very often are suboptimal and sometimes just downright irrational decisions. And that is a universal practice of every dealer in the every dealer in the industry. Now, you may ask the question, it would be a fair question to ask. How is it, if this is true, Dale, how is it that we got to be 100 years into this industry making decisions on a flawed premise and none of us ever recognized it? Well, let me explain that this way. Think about this. If I was a builder architect and I designed and built a building using a ruler that was a couple centimeters off, if you stood back and looked at that building through a haze of fog, you might not notice that anything was wrong with it. But if that fog lifted, you would see that building clearly for the first time, and you'd say, wait a minute, there's something wrong, there's something off. Well, here's what we've been doing in the industry for the past 100 years. We've been looking at transactions through a haze of fog of profitability. It was so easy to make money in the used car business that we never really could see through that profit to see that we could have made more profit because we're looking at it through that haze of profitability fog. But when the fog of profitability began to lift in mid-2016 and 2017, and we could look at millions of transactions and see why we were producing negative ROIs, it started to be very, very obvious. Vehicles that represent poor investment quality on a day one are ones that we're pricing on the flawed premise that they hold their greatest potential. And conversely, vehicles that hold great ROI potential longer than others, sometimes as many as 45 days, are still yellow bananas. I mean, after all, what would Dale Pollak have said to you previously about every vehicle at 45 days? Every vehicle I would have said at 45 days needs to go away. And the reality is that most probably do, but not all. Not all vehicles age at the same rate, just like not all bananas necessarily age at the same rate. So we never have had the ability to see these vehicles truly for what they are as investments. We've all assumed improperly that every vehicle on day one holds its greatest investment potential and begins to deteriorate from there, and it's simply not true. But there's other reasons as well. In addition to making decisions universally on this flawed premise that the amount of time we hold a vehicle equates to its profit potential, it also is caused by simple human nature. You see, basic human nature is that we're all pain avoiders. Imagine how miserable life would be if we woke up in the morning, all went out and looked for pain. We do the opposite. So if, and I stress if, you went to work this morning and you were able to recognize a vehicle on day one that was in distress, who wants to jump on that grenade? Nobody. In fact, not only does human nature avoid doing that, but our past practice would actually encourage us not to do it, because in the past, if we owned a car for too much money on day one that had high market day supply and low volume, typically if we waited long enough, somebody would come along who didn't know better, and they'd take that car off of our hands for too much money, and nobody would have ever had to jump on that grenade. But as we know today, that doesn't happen nearly often enough to be a sound practice of running a business anymore. But that is, in fact, consistent with our human nature and our past practice not to address these problems. But yet, every single one of us understands that if we have a vehicle on day one that's in distress because it has poor ROI potential, we all know that we'd be better off dealing with it sooner rather than later. So you see, these are some of the large contributing reasons that has everybody in the industry. And I'm telling you, every one of you, I can prove it to you. I can show you your inventory for the very first time through this investment lens, and you will see that you too have an inverted pricing profile. And then we wonder why we're in this negative net profit trend. Well, no kidding. We are all doing it wrong. And I believe that the opportunity for us to reverse this negative trend is within our grasp. But I'm going to tell you something. It's really hard, really hard. Let me give you the good news and the bad news. Let me begin with the bad news. It has proven to be so difficult beyond anything that I ever would have imagined to get a dealer to what I call uninvert their pricing profile, meaning that their platinum cars should be priced the highest, followed by gold, then silver, and then bronze. Now, you would think you could just sit down and reprice your vehicles overnight and have that straightened out. But what you have to understand is that to actually behave as a true investor would run contrary to most everything that we've ever been taught or learned to do in the past in terms of in terms of managing used vehicle inventory. I mean, if you had a vehicle on day one that you could recognize as a bronze vehicle, as a rotten banana, and you price that vehicle today for zero profit, who's going to give you a pat on the back for that? They're going to criticize you for doing that. And conversely, let me assure you how difficult it is to pass what might be a very healthy front-end profit, maybe an $1,800, $2,000 profit on a platinum car that's been in inventory 5 days. How hard is it to pass that? The temptation to grab that deal and run is great. But in reality, if you were more patient with that car, if you gave it another 25 or 30 days, that car would certainly make a $4,000 profit. But to be patient and wait for that, somebody would criticize you if you pass that $2,000 deal. So you begin to understand that thinking and behaving like an investment manager goes against the grain of virtually everything we've ever been taught or trained to do. It's not consistent with our past experience. It's not consistent with the incentive structure upon which we get paid and promoted in these dealerships. So it really goes against the grain. But I want to remind you that management is about doing things right. But leadership, on the other hand, is about doing the right things. And what's incumbent upon a leader is to have the ability to see with sober vision what's going on in the industry and have the courage and conviction to lead change. But this is change, for the reasons I stated, and many others, is very difficult. But can I tell you the benefit? The benefit is tremendous. The dealers that are able to make this transition from managing inventory as merchandise and managing inventory as investments are seeing gross profit, total gross profit, and net profit reversals in the area of 60 to 80%. And I almost feel silly saying that, 60 to 80% improvement in total gross and net profit, because nothing creates improvement in a business to that extent unless you solve for a very fundamental problem and you do something very fundamentally different. And this is a fundamental problem. I can demonstrate to any single dealer, any dealer, that you are actually pricing your best vehicle investments, leaving tremendous amounts of gross profit on the table, and you are hanging on with some hope of getting lucky and at a very high cost, I might add, of your worst vehicle investments. And if, in fact, you're able to reverse that irrational behavior, the upside, the reversal in profitability is absolutely tremendous. But it is very, very difficult to achieve for the reasons that I said. So this concludes the formal part of my remarks. And what I'd like to do is I'd like to turn it back to Steve for questions, please.
Okay. Well, thank you, Dale. Very good. I just had, I want to start one out with my own question. Like, in a perfect world, every car would be platinum or at least gold. So would you recommend that dealers only stock platinum and gold?
Yeah, thank you for that question. Steve, another point, if we could put up the composite again, I want to point something out, that if you notice in this composite, more than 50% of the inventory is silver and bronze. And this will happen to be the case for most every dealership. More than half of the vehicles in inventory are essentially brown or rotten bananas. And can I tell you, Steve, what that does not mean? What it doesn't mean is that the dealership management is making bad acquisition decisions. It doesn't mean that at all. Let me tell you what it does reflect. It reflects the very, very difficult, competitive, transparent reality of today's wholesale market. I mean, stop and think about it. Sometimes you have to go to auction to buy cars that you need. So what auction, Steve, are you going to go to buy a low market day supply car that's got high volume and buy it cheap at the auction? No auction. And yet you have to buy those cars when you need them. And even when you trade for cars at the dealership, today shoppers are so well educated about what the real ACV of their trade is, and you've got so much pressure to sell new cars, that what's your opportunity today to get a trade-in cheap? Very, very infrequently. So this is simply your reality in the used car business today, is that you got to trade for cars and you got to buy cars, and the opportunities to buy low market day supply cars that have high volume and buy them cheap is very rare. So I will never, Steve, I will never criticize any dealer for having more than 50% of their inventory being silver and bronze. Quite frankly, they can't help it. But you know what I will criticize you for? Is how you treat them. Not recognizing them for what they are and not treating them as a prudent investor would. So, Steve, to your question specifically, would I encourage dealers to stock only platinum or gold cars? No, because it's impossible. You wouldn't be stocking many cars at all. And listen, I think that silver and bronze cars are great opportunities, providing you see them for what they are and you handle them correctly. I mean, stop and think about this, and this is the case for every dealer. If roughly 50% of your inventory is priced as you have it priced, silver and bronze cars as you have it priced, essentially not to sell, what do you think would happen to your volume overnight if you price those vehicles to sell? Your volume would go off the charts. What would happen to your F&I gross? It would skyrocket. What would happen to your internal fixed gross replacing those cars? It would skyrocket. So it literally is the case that I love silver and bronze cars, providing I can recognize them for what they are and I'm willing to treat them for as they should be, and that is volume cars, unit cars, means they need to be priced right from day one. So I am not critical of the mix of vehicles, and I'm not prescriptive about, how dealers, inventory should look in terms of platinum or gold. But what I am very insistent upon and very prescriptive about is that you treat them properly. What treating them properly means is not giving away in too much of a hurry silver or platinum and gold cars, even though they show you a good front-end profit. Be more patient with it. And on the silver and bronze side, I'm very prescriptive and very insistent that dealers recognize those cars for what they are. Those are cars that need to go away quick. The quicker they go away, the less they're going to hurt. Does that make sense?
It certainly does. Well, then how's it possible that someone would consider a bronze car as the proud car, as you said, and the platinum vehicle as the blowout vehicle? I mean, what's going on there? Is it a psychological thing?
They don't. Right. That's right. So here's what is happening psychologically. The bronze cars are the ones that, typically speaking, have a high cost to market. We own them for too much money. So even though no one in the industry, or very few people in the industry, will ever admit that we're pricing vehicles from cost, what this investment approach shows you is that to varying extents, almost every dealer, to some extent, prices vehicles from cost. So what happens is that they own their silver and bronze vehicles for too much money, and that causes them to price them too high. Now, when 50% of your inventory or more is priced too high, essentially not to move or not to move quickly, management's got a problem. They are under a lot of pressure to do volume and create turn. So while a dealer sits there, a manager sits there with roughly 50% of their inventory priced not to give them volume or turn, and yet they get pressure to create volume and turn, where do you think they go to get volume and turn? They go where it's easy. They go to those platinum and gold cars. Those are cars that are super easy to sell fast, and they make decent front-end grosses. That's why this happens. That's the psychology that's playing out here. And I think that, once you see it for what it is, nobody would say that that is an investment-minded way of making money. It's exactly opposite of what a prudent investor would do. A prudent investor would want to get out of a poor investment as quickly as possible, recognizing they'll get better with time. And a prudent investor with an investment that holds high potential would be patient to get the very most they possibly can out of that investment. So there's the psychology, and it's irrational behavior for the purpose of maximizing ROI.
Yeah. All right, here's one from the audience. Day supply is a metric that looks 45 days back in the market, and the market is faster moving than ever before, even to the point that 14-day trends are more relevant based on our monthly investment. How is day supply still a top metric in a faster moving market? if in May, when shopper counts are typically down, I am looking at a day supply from March. Isn't it possible that the day supply is not relative to the current market in most markets?
Sure. I don't think that there's any number that anybody could pinpoint that would be a perfect number. I personally think that 60 days looks back too far, and I think that if you look back 14 days, 14 days, I think you could criticize as possibly being too short, because it's very common that our industry sales ebbs and flows. And it doesn't always do it predictably as we think it would according to the calendar. It ebbs and flows. So, 14 days, you get a slow 10-day period, and it looks like nothing's moving. But we've all been through slow weeks or slow 10-day periods. First half of the month slow, second half of the month picks up. Would you really want to just measure based on the last 2 weeks of that slow month? Or conversely, if it happened the other way, the fast month? No, I don't think so. So, no, I mean, somebody can be rightfully critical of any number. But in my mind, and generally speaking in the industry's mind, I mean, the new car manufacturers measure market day supply based on 45 days. So it's an industry standard, not perfect, but I think in my mind at least better than 60 and better than 14. But not perfect.
You had said
I appreciate the question. It's a fair question.
Yeah, it is. We were talking earlier when I was interviewing you, and you said don't stock ahead of your sales. Sell cars to earn the right to stock cars. Could you elaborate on that? It basically is to avoid overstocking.
Right. So another critical strategy which I advocate is that dealers run what I call a balanced equation. And a balanced equation means that there is a direct correlation between a department's profitability and the extent to which it stocks a 30-day supply. Now, see, what used to happen, well, the way the math works in the used car business is that you buy a car today, and every day that goes by, the average market price of that vehicle comes down a little bit, which reduces your opportunity for return. Well, the reality is in the last several years, the rate at which that market price comes down is become much accelerated. It happens much faster than it used to happen. It used to take about 60 days for a vehicle that entered a dealer's inventory on day one for the right amount of money. It used to take about 60 days before the average market price drew within 10% of the dealer's cost. Well, today it takes about 30 days on average. So if it used to take 60 days for a vehicle to run out of net profit contribution, today it takes about 30 days. So the reality is that if you sold a vehicle out of your inventory today, you probably own it. Excuse me, let me restate that. If you sell a vehicle out of your inventory today, it's been there more than 30 days. You probably own it for a cost to market of 90% or more, meaning that your cost that you own it for is within 10% of its average market price. And obviously vehicles aren't transacting at their average asking price. They're transacting in the low to mid-90s. So if you own a vehicle, or if you sell a vehicle out of stock that's been in inventory, let's say 30 days, it probably transacts in the low to mid-90s, let's say around 93%. You probably own it for about 90% cost to market. That's a 3% front-end gross. So you sell the vehicle and you make a 3% gross. And listen, it's not the gross you want or you really desire, but at least you feel as if you're making a contribution to the bottom line of the department. That's what you see. Can I tell you what you don't see? What you don't see is that likely you just transacted a net loss. Reason being, on a small 3% spread, once you pay a salesperson a commission and you allocate departmental expenses to that transaction, by the time it hits the bottom line, it's probably a negative hit to the bottom line. That's what you don't see. Mm-hmm. This is the first of many examples that I write about in my book that I call gross deception. It's gross deception. You think you're making a positive contribution, and you don't. And this happens to be the reality at most every dealership for most every vehicle that's been in inventory for 30 days. These vehicles do transact. They often show front-end grosses, but by the time they hit the bottom line, the net profit line of the department, they're losers. So if our industry had recognition of net profit per transaction as opposed to gross profit transaction, we wouldn't have to have this conversation. But unfortunately, that's not the way that our industry tracks performance on a net transaction basis, but you can certainly see it on the bottom line of your department. That's probably why it's negative or headed into negative territory, is that you're stocking more cars than you should. And I recognize this is a fundamental shift where we used to stock cars to sell cars. And today I say that's wrong. Today, once you understand what I now refer to as the new math of the used car business, that meaning that the vehicles generally are owned for 90% or more of their average retail price after 30 days, what we no longer do is stock cars to sell cars. What we have to do is we have to sell cars to earn the right to stock cars. So that gap between your current inventory and your rolling 30-day sales, the larger that gap is, the more negative transactions you're going to affect. The smaller that gap is, the fewer negative net transactions you're going to affect, whether you recognize them as such or not.
Yeah, good. Okay, somebody asked, how does profit per day fit into your hypothesis?
Profit per day? Well, profit per day is implicit. It's a component of ROI. So an ROI calculation isn't just based on what you grossed on the deal. The ROI calculation imputes to that not only what you grossed, but how much did you have to invest to make that gross and how long it took you to make it. So strictly a profit per day doesn't account for how much you had to invest to make that profit. What does account for that is the ROI. The ROI accounts for how long and how much it took you to make that $2,500 gross. So I believe that the ROI calculation of vehicle sale is one that our industry has never recognized as being an important metric. And today, for all the reasons that I stated, has got to be the primary driver of, or I should say that the primary point of understanding success in the business, whether it be on a transaction by transaction basis or whether it be on a departmental outcome. ROI is how businesses make money, maximizing, optimizing ROI. And as I outlined, every single dealer without exception, and I could prove it to any dealer, is behaving in a manner that is actually designed to sub-optimize the ROI.
Okay, and somebody asks, this kind of ties into what we were talking about a little earlier, Dale. Does the sale price include a margin for overheads already? Or should it?
Does the sell price?
One would think you'd have, the sale price, the price, of the car, does that include a margin for overheads already? That could potentially eliminate that 3% problem of, it being eaten up by other costs, right?
No, I don't think it does. I think it's the gross, and more specifically, it's the ROI that accounts for overhead. I mean, you can sell a $50,000 car and make $1, or you could sell a $10,000 car and you can make $3,000. They would be very different ROIs. It'd be very different gross profits. So no, I don't think that the actual sale price of the vehicle accounts for the overhead. I think what ultimately accounts for the overhead is the ROI, not the gross. And the gross is what our industry has been grounded on for the past 100 years. It goes back to that $2,500 gross example. A $2,500 gross is not a $2,500 gross in terms of a business generating profit. They're very different depending on how much you had to invest, how long it took you to make it, and sale price is not a component of that calculation.
Okay. And then another question is, what is your ROI formula based on cost to market, day supply, and retail volume?
Well, ROI, the cost to market day supply, and volume are simply the three most significant conditions of a vehicle that are predictive of its ROI outcome. The ROI calculation is a function of how much did we have to invest, how much did we gross, and how long did it take us to gross or make that gross, how many days did it take us to make it. So not to be confused, the cost to market day supply, and volume are simply the inputs that develop the investment score upon which we then take action according to its ROI score potential.
Okay. Another question, what are your thoughts on dealer PACs? And that's PACKS.
Yeah. Well, PACs are taxes. By definition, anytime you add an amount to an item that is not offset by equal or greater value, by definition, it's a tax. So if you put a PAC on a car, but you include a 90-day limited warranty, and if that PAC is a $500 PAC and the actual market value of that 90-day limited warranty is $100, then what you've done is you've taxed the vehicle. You've taxed it $400, difference between the $500 and the $100 of value that you added to the vehicle. Now, everybody knows that the more you tax transactions, the fewer transactions you're going to ultimately affect. Everyone knows that. But you see, these taxes that we fooled ourselves in the past and called them PACs were not the problem that they were today. Because if the dealer taxed the car in the form of a PAC, or the service department taxed the car in the form of a reconditioning amount that far exceeded the market value of the improvement they made to the vehicle, in the past, those taxes could be passed on from service to sales or from dealer to sales to customer. The customer ended up paying the tax, absorbing the tax. Well, that worked fine when customers weren't as educated about vehicle values and alternative choices as they are today. But today, given as smart as shoppers are, they can recognize vehicles that have been taxed with these PACs. They sit out on dealers' lots, very conspicuous, with higher than average or higher than competitive prices. And what happens to those vehicles? They sit. And as those vehicles sit, the margin compression occurs, and ultimately the dealer accepts an outcome on that vehicle far less than they would have had they not taxed that transaction. So PACs are problematic. They don't work like they used to work. And I would encourage dealers to eliminate or reduce the PACs. Let me say this, I would not encourage any dealer to eliminate, or for that matter, perhaps even to reduce their PAC until and unless they got a handle on discounting. Because those two strategies have to work hand in hand. Because the fact is that, if you removed your PAC before you had your discounting measured and under control, you probably would go backwards in gross. But I can tell you this, the most profitable dealers, used car dealers in the country, have the least, if any, PAC, contrary to conventional wisdom. The dealers who have the largest PAC, Steve, have too many vehicles, and many of them are aged vehicles, and they sit on the balance sheet overvalued, and ultimately they're going to be sold and losses are going to be incurred.
Okay, this is kind of a tie-in question, Dale. Do you have a metric or philosophy on used car per unit dealer PACs? And I think you just explained your philosophy, but if you're going to do it, is there a metric to it?
The only metric that I could put to it is reduce it. But as I said, I would not advocate reducing or eliminating PAC until you've got your discounting, your discounting under control. Because if you eliminate the PAC and discounted the same amount, it would not be a good outcome. But clearly, PACs are taxes. And we all know what taxes do to commerce. They don't help it. They bog it down.
Mm-hmm. Okay, question is, the major issue is the people making the price decisions, both on new and used, are not compensated on turn. All the bananas are the same color to them. The person who said it's just a comment, not a question. Do you agree with that?
Yes, I do agree with it. And this is one of the key reasons why it has proven to be so difficult for dealers to behave as a prudent, rational investor would, because it does go against conventional compensation programs. You know, nobody gets rewarded for selling a distressed vehicle on day one. Nobody gets rewarded for passing an $1,800 front-end gross today. That should have been and would have been a $4,000 gross all day long if they had held out for a higher price. Nobody gets rewarded for these things. So I recognize it, and the question is completely valid. The incentive compensation program actually encourages and rewards irrational behavior.
That's bad news. Somebody asks, up to what point do you think dealers should rely on the sale of back-end products to maintain profit and cash flow?
As much as possible. You know, when I talked about a few minutes ago about stocking no more vehicles than you're selling in a 30-day period, it's easy for people to believe that that means we're going to do less volume. It certainly can mean that. But it doesn't have to mean that. I can reference anybody to dealers that have gotten it down where they're stocking a 30-day supply based on their past rolling 30 days that actually are selling more volume. And I also want to make this point very clear. Dealers today believe that volume cures all ills. I mean, after all, our industry has sold record volumes over the past several years, and yet half the dealers are in the red and the other half are headed to the red. So I want to tell you, volume does not cure all ills. Volume is important, but you have to do volume smart. And if you really just think that volume is the key, I've got good news for you. I have a surefire strategy that will 100% guarantee you more volume if that's what you think it takes. Just go out and double your inventory, triple your inventory. I guarantee you, you'll do more volume. And I guarantee you, you'll lose more money because those vehicles that you stocked that you didn't sell in 30 days, they eventually will transact, and they will transact at net losses, if not also gross losses. But that proves the point. You see, volume is important because obviously the question is understanding of the fact that volume drives F&I revenue, it drives internal fixed revenue and gross, and that's important. But you can't just do volume. You know, a story in early 2018, I got a call from one of the largest Ford dealers in America. Everybody knows this dealership's name. It's been in the family for 3 generations. And the owner called me in January of 2018. He said, Dale, he said, last year we had the biggest volume, used car volume year in the history of our store, and we lost money. I said, I get it. I completely understand. I said, this is the story that's now playing out all over America. Dealers are doing big volume and they're losing money. And the reason is that they're stocking too many cars. The reason is that they're pricing vehicles in an irrational manner to suboptimize the return. And until we recognize that the basic math of the used car business has changed, that being that vehicles run out of net profit juice somewhere around 30 days, until we understand that the way we think about pricing vehicles is designed to suboptimize, until we come to terms with the fact that this is the reality, we're going to keep doing the same old thing. You know, and I want to make this point, Steve. Think about how often you have to update the operating system on your computer or your smartphone, like all the time. And why do you have to do that? Because the environment is changing all the time. Well, when you really think about the fundamental profound changes that occurred in our industry over the past 10, 15 years, largely driven by the internet, how much has our used car management operating system or playbook changed? The answer is very little. So we have to recognize as leaders that the environment is fundamentally different. The basic math of making money in the used car business has changed. And unless we're bold enough as leaders to lead that change, we're going to keep operating according to the old operating system, and it's no surprise that things are going to grind down slower and slower and finally to a halt. And I submit to you, that's why half the used car departments in America are in the red, the other half are headed to the red in spite of record volume. Time to change, folks. Time to change.
Well, speaking of time, we're almost running out of it, so we have some questions. If we can do kind of a lightning round here. With the extreme rise in used car prices at Manheim, and now we are seeing the prices drop almost as quick, could the profit time score be thrown off due to the fact that the retail market still has the cars bought at the high prices still for sale?
Yeah. So the profit time score gets recalculated on a nightly basis, and it will move with the market. I would submit to you that, yes, the wholesale market prices are coming down, but it's not drastic. It's slow. And I don't necessarily see anything in the environment that's going to cause drastic changes in wholesale prices or retail prices. I think they are going to come down, but I think it's going to be, I don't think it's going to be a burst of a bubble. I think it's going to be a deflation of what we see in a bubble in terms of retail and wholesale pricing. So I'm not concerned about abrupt changes that might throw off the profit time score.
Okay. We're going to just go a little over time because we have some good questions, and I'm not sure we're going to be able to answer all of them, but we'll try to answer most of them. What are the guidelines that separate all the different buckets? For example, is 80% cost to market average days supply 48?
Yeah, as I said, and this is a very deep conversation. It gets very technical very fast. It gets really down in the weeds. But as I said, the weighting of those three factors, market day supply, cost to market, and volume, varies from car to car based on a variety of factors. And if anybody really wants to have that discussion, they're entitled to have it. It certainly would be helpful if they understood and had confidence in how those scores are generated. But it's one that, quite frankly, is beyond my level of ability to explain. But I've got people who are equipped and ready to explain it to anybody who would like to understand what drives the weighting of those three factors. But it is different from car to car based on a number of conditions.
Okay. We'll have to make this the last one. I think it is possible that we'll be able to answer the questions off the program that we haven't asked or gotten to. So how can we be sure that vehicles are platinum, gold, silver? How can we be 100% sure about this metric? It is such a volatile business.
Great question.
These kinds of classifications don't exist in the stock market.
Great question. I appreciate it. You know what? I ask people to have faith in the score because it's proven over and over that it works. What I don't ask people to have is to have blind faith. There are, in fact, aspects of a vehicle that the score does not consider. Color could be an example. An odd odor or tick in the engine could be an example. The market day supply, cost to market, or volume cannot detect some of those factors. So there is definitely room for human judgment in the analysis of these scores. I would tell you they have proven to be extremely reliable in terms of being predictive of the ROI outcome, but we still need the good human judgment factored into it. So thank you for that question.
Yeah. Well, thank you. Gosh, I could talk to you all day, Dale. It's so bright and such an insider. But we're out of time. So I'd really like to thank you for an outstanding presentation and great answers. As a reminder to the audience, you'll receive a follow-up email that will include a link to view a recording of today's presentation. Feel free to share it with your colleagues. And a short survey will pop up soon in your browser. We'd appreciate if you could provide us with the feedback. Thanks again, Dale, and thanks to the audience for attending. And goodbye. We'll see you next time.